Futures rally hard, 12 minutes until the start of the cash trade on this jobs day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shanali Bassick.
And I'm Katie Greifeld. We're wrapping up a packed week with a robust jobs report. You can see that futures shaking off some disappointing tech earnings last night, rallying. Exactly. Taylor Swift style. You can see the S&P 500 up 1.2%. We closed out 8 straight days of gains yesterday. If we make it to number 9, that'll be the longest streak since 2004.
Stocks to watch today include Apple. It plans to source more than 19 billion chips from the U.S. this year as part of a global supply chain shift to gradually lessen its reliance on China. It sees a $900 million hit in this quarter alone coming from tariffs. It'll be the first Mag 7 stock to drop on earnings this quarter.
Interesting. We're seeing Amazon saved by that jobs print. It actually turned in the green after we saw that. Yet it expects a tougher business climate in the coming months due to tariffs and a potential downturn in consumer spending, with the slowdown already appearing in third-party revenue.
We're going to dig into those reports in detail, but Bloomberg just spoke with Chairman of the White House Council of Economic Advisors, Stephen Myron, about the state of this labor market.
Given the historic scope and speed with which the president acted to put American workers and firms first for the first time in decades, it shouldn't be surprising if there's some accompanying volatility, and that extends to financial markets that we've seen, and it could extend to economic data also as companies sort of substitute activity from one month to another. That remains to be seen.
All right, for more reaction to the jobs data, we bring in Bloomberg's chief economics and policy correspondent, Michael McKee, joins us here on set. And 177,000, better than the highest estimate in our survey. Is this economy on fire?
The economy was very strong coming into 2025, and the labor market was the strongest part of it, which the Fed has acknowledged. We are seeing a slowdown. We got 177,000 jobs. March was revised down to 185 after 58,000 jobs were subtracted from March and February. But it's still a healthy number. The 3-month average is 155,000 jobs a month. That's up from 133,000 last month. Unemployment basically unchanged, even out to 3 digits. Average hourly earnings, all basically unchanged on a year-over-year basis. We always talk about the biggest movers, but this time I looked at what moved that might have been affected by tariffs. Healthcare and social services, social assistance. A lot of the charities that the Doge people were cutting back on funding to didn't make a difference. Still 58,000. Construction jobs. We were supposed to lose construction workers because of the immigration crackdown. Didn't happen. 11,000 jobs there. We did lose 9,000 in federal government. We would expect that to rise in months to come. And computer manufacturing, I just threw that in there, down 4,000 jobs. Semiconductor manufacturing also down 1,000 jobs.
All right, Mike McKee, stay close. We're going to see you at the top of the 10 a.m. hour as well for factory orders. That is Bloomberg's Mike McKee. And let's keep this conversation going now with BlackRock Chief Investment Officer of Global Fixed Income, Rick Rieder. Rick, it's great to see you again on this jobs day. You take a look at the pre-market action. You have stock futures flying right now. You have traders backing away a little bit from their Fed rate cut bets. It seems like traders are taking good news as good news here. Is that your read as well?
So I think there's a couple things at play. I think the rate market is rightfully factoring in. You got an economy that's still solid, that labor is still solid. It's got to keep the Fed on hold for a longer period of time. So I think that's the right adjustment. Listen, the equity market, I tell you, this is one of those interesting periods of time where there's so much cash that's been sitting on the sideline that even though valuations in equities, quite frankly, are not that attractive, that money keeps flowing in. And it's something with the story improving about maybe we get some trade deals. You're seeing momentum and sentiment push it along, even though when you actually break down valuations in the equity market today, I would say they're not terribly fulfilling.
Rick, let's talk a little bit more about the jobs numbers themselves. I know that you've been looking at this not just on a standalone basis, but on a 3-month rolling basis at the minimum. What are you seeing in terms of the trend, in terms of where jobs are coming in and going away? Is there anything encouraging at this point, or are you more discouraged?
No, so I think, I actually brought a chart with me, a little visual aid that I don't know if y'all can show that. So
yep, up right now.
Mike McKee, there you go. What Mike McKee said, which I think is incredibly important. We have a service economy. People that talk about the death of the U.S. economy don't respect the fact that services push this economy along. Healthcare, you look at healthcare and education, and then obviously leisure and hospitality, they just continue to move along. Less trade, less tariff sensitive. And then people spoke, I was listening to somebody today talking about the goods economy. When you actually look at what labor is, the labor is a service economy, and it's still humming along at a pretty good pace. Here's what I think is the delta of where we are today versus where we were a month or two ago. Services are still doing well. I am focused on healthcare and education and leisure and hospitality because I do think you'll start to see those cuts come through. You know, we talked about some of the federal funding cuts to healthcare. I think the next couple of months that'll start flowing through. Leisure and hospitality, you see some of the tourism data coming off. I think that'll start to flow through a bit. So I think the delta is to slower numbers. And you know, the interesting thing in the JOLTS report this week, look at job openings. That's actually, in some of the sectors I just identified, that's coming off. CEOs, CFOs are sitting in this point today, I'm just going to wait. I'm going to cut my job openings. I'm going to keep my labor in place in case the economy actually does okay and we get through some of these tariffs. But it's really interesting. Openings are coming down. So the delta is lower, but it's coming from a pretty solid place. And services, when people keep, arguing U.S. economy, service economy is pretty darn good.
I wonder how important manufacturing jobs are to you, Rick. I mean, Ralph Schlosstein told us manufacturing makes up only 8% of U.S. jobs. And on the other hand, if you have a good union job building cars, you can support a family with that in Michigan. So is it really key to bring back these manufacturing jobs, or do we want to move forward with higher tech service economy?
So Ralph's a smart guy. I would say I agree with everything that was characterized. I would say a couple of things. One, I do think that you'll see manufacturing. You see the pharmaceutical industry start to motivate towards putting more people in the U.S. I do think there is a social aspect, quite frankly, to bringing people back into some of these areas of manufacturing. And I think you'll see that take place. Listen, first of all, it takes 3 to 4 years really to get that sort of dynamic moving and to see some significant impact there is point one. Point two that I think is significant, robotics and automation will dull the labor impact you'll see from that. I think more factories that come back in manufacturing will be with a lot of robots and automation. And then I think the third point that is significant, listen, the growth of technology and innovation, and you think about chip development, et cetera, they are critically important to the United States from a growth, from a national security point of view. And so I think that's where you'll see the primary aspect of what you would call new manufacturing today.
All right, Rick, you're sticking with us through the opening bell. Hold tight for just a moment. Let's take a look at the setup as we count down to the ringing. You can see the S&P 500 up 1.2% right now. What a run we've seen on the big benchmark. You can see the NASDAQ 100 also higher, even though we had a little bit of disappointment from Amazon, from Apple. Amazon shaking that off again, Taylor Swift style. And then you have the Russell up as well. It's going to be interesting, guys, to see if we can close in the green on this Friday. We know that traders have been reluctant to hold risk into the weekend, but if we get 9 straight days of up arrows, that is the longest streak since 2004.
As you've been saying all week, yesterday was window dressing, but window dressing is over. It's time for people to return to trading.
Yeah, the best string of gains, though, in 21 years. This is Bloomberg. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller, and we are looking at some pretty significant gains, especially considering that we're just passing over an 8-day streak. So if we finish in the green today, it'll be the longest winning streak we've had on the New York Stock Exchange in 21 years. That's longer than many of my colleagues here have been alive. NASDAQ futures up 1.1%. Russell futures all up 1.1%. And ringing the opening bell, really knocking it out of there, is Oscar De La Hoya. And Ring Magazine, which is, I guess, a boxing magazine, and they're partnering up with Fatal Fury, which is a video game. I need Joe. Sometimes I need Joe in the control room out here to help me out with this sports stuff. Down at the NASDAQ market site, you have Fold ringing the open bell, FLD, and they brought a huge crowd of people. What a day to be involved in financial markets. I mean, the kind of record we're looking at, Katie Greifeld, is generational.
Generational. I do have some bad news, though, and that comes in the form of Apple. Apple planning to source more than 19 billion chips from the U.S. this year as part of its global supply chain shift to gradually lessen its reliance on China. But even still, Shonali, we learned last night that it sees a $900 million quarterly hit this quarter alone from tariffs, so standing out from the rest of its magnificent seven peers in a bad way.
Yeah, this one too is interesting. Amazon had been fluctuating into the market open. Now it's down, roughly flat. It's been fluctuating between 0.2 and 1% down and flat. It expects a tougher business climate in the coming months due to tariffs and a potential downturn in consumer spending, with the slowdown that's already appearing in third-party revenue, Matt.
Yeah, I want to point out also that Chevron will reduce share buybacks this quarter due to tumbling oil prices. I know since the first quarter we're down about 17% on crude prices and the trade war. Meanwhile, Exxon is sticking with its share buyback plans as earnings met estimates there. So kind of a mixed bag in terms of the oil patch, but both of those shares are rising right now. And we've got some breaking news on a meeting at the White House. President Trump set to meet with Mark Carney, the new leader of Canada.
Right, he had a good week.
And this is interesting because Carney, in his sort of victory speech after the elections this week, he said, friendship and partnership and collaboration between the U.S. and Canada is over.
Yeah, he did run on that sort of anti-Trump sort of platform. It ultimately got him the victory, but now learning that Carney and Trump are set to meet at the White House on Tuesday, it'll certainly be interesting to watch that one.
Yeah, Tuesday next week is a busy week, of course, and we should be prepared for that because we're going to move past these earnings and back into the political rhetoric. That meeting on Tuesday will be closely watched, in addition to many of Scott Bessent's hearings.
Exactly.
Well, before we move on entirely from earnings, let's talk about two of the big ones, Apple and Amazon's results. Let's take a closer look now with Bloomberg Technology co-host Caroline Hyde sitting to my left. I want to start with Apple because there were already a lot of fears heading into this print, of course, the relationship with China, the reliance on China, and it seems like actually a lot of those worries were founded in reality.
Yeah, Tim Cook just reminded everyone of their exposure and the fact that they're already saying, look, costs are going to add up to $900 million. That's not a lot if you're comparing that to, your expectations of about $90 to $100 billion in revenue. It's about 1%. But that is the best case scenario. So says Jefferies. This is why we got not one but two analysts downgrading the stock today. And in fact, Jefferies going all the way to an underperform, saying this is as good as it gets. You're going to have, of course, perhaps tariffs not remaining still as they are in the next June quarter. We're going to potentially see a dial-up of focused tariffs on electronic goods, such as smartphones. So overall, we're going to see a real concern here. Apple really couldn't point past what happens in the June quarter. And they're also that weakness in China, just persistent. They had subsidies in China. We're meant to see a pickup, but no, sales were still down 2%. They cannot get their AI act together. They're not having a foldable phone yet, and they're losing out to competitors over in China. Meanwhile, in the US, yes, you're building chips closer to home, but that adds up.
Speaking of competitors over in China, I think this week was an incredible one for Amazon. The numbers themselves were not so pretty. They were down more than 3% pre-market. The jobs numbers showed up and it saved them a little bit because they are so exposed to this consumer, the American consumer. But Chinese rivals have been raising prices already. Yes. So is this an advantage story or a disadvantage story?
I think when you're thinking of Amazon, if anyone can weather it, Amazon can weather it. It's kind of where analysts are. And the sales look good. Not only did they beat in the quarter that they just reported, but they're also posting that revenue is actually going to remain resilient. They're going to see about 8% growth once again. They might take away something on profit, but people are used to that when it comes to Amazon. Just go back to the Bezos days when he was running it. And now with Andy Jassy, they're always willing to flex a little bit on their operating margin if they're going to reinvest in the business. And they seem to be committed to satellites in the sky. They're committed to AI innovation and wanting more people to come to Bedrock, more people wanting to come to their own chips. So they're not going to say in this moment of anxiety, we're dialing back on our own R&D, but you're going to have to suck up a margin hit. I think most analysts actually said, look, generally speaking, they beat when it comes to their operating income. They beat hard this quarter. Look, the guide, they're just being cautious here.
All right, Caroline, thanks very much. Bloomberg's Caroline Hyde. She hosts our technology show, which kicks off at 11 a.m. with Ed Ludlow, and you can watch that at 11 a.m.
There you go.
As I said. We are back with BlackRock Chief Investment Officer, Global Fixed Income, Rick Rieder. Rick, you also run BINC, the ETF, which is outperforming the benchmark, really crushing it, and up year to date, as opposed to the S&P, the broader index, which is down still almost 4% year to date, still off 8% from its highs. What do you think about stocks after a 9-day winning streak? I mean, do you take some profits here?
So thanks, Matt. I also run our global allocation fund where we do mostly equities. Listen, I'd say a couple of things that we're doing in the equity market. First of all, this is as good a trading environment as I've seen in a long time. You know, there was a period of time where people were panicked about the downside, and you could sell puts on the market, reduce your equity beta, sell puts. And now you've got this amazing froth that, you know, you ride it a little bit. You run your equity beta a little bit longer because the sentiment's good. Maybe you get good news on trade. But now there's a great opportunity to sell upside calls because people will pay for the up 10%, 15%, and buy some downside. And so that's what we've been doing recently. You know, ride this a little bit, keep your beta elevated, but you can buy some downside protection. And I think, quite frankly, you know, some of the names that are moving now in tech and otherwise, you can sell some of the upsides because people have gotten super excited again, and then protect yourself so you can ride an equity market. Listen, the valuations, you're talking about 22, 23 times earnings. These are not great valuations. It's a sentiment-driven market, and it's one that there's just so much cash that people are looking for an opportunity to put some money to work. So anyway, you ride that, and then you know try and protect yourself in terms of any bad news.
Rick, it's funny. You have to keep reminding us that you're not just a bond guy. Unfortunately, that label has definitely followed you. But when it comes to what you're describing in the equity market, you know, protecting on the downside with puts, selling upside calls, it's interesting. It kind of sounds like you're trying to generate income through the equity market with some of these options structures.
So yeah, yes, on generating income, but also to try and, you know, create the right convexity of your portfolio. Meaning, you know, can you participate in a market where it's rallying, but then also when people get excited about the upside, can you build some downside in the portfolio? And then the flip side, I mean, you know, we were selling downside. You know, we'd reduce some risk. And so selling some downside in things like the banks. You remember, if you go back 2-3 weeks ago, banks were down 25, the big banks down 25-30%, and the volatility that usually trades at 20-25 was at like 80 to 100. So those opportunities present themselves. So trying to take advantage of, yes, build income when you can, but really trying to take advantage of where, quite frankly, I think we live in markets more than anything I've ever seen, where people overreact, sentiment drives it, momentum drives it, and just trying to be on the other side of that when it gets a bit extreme.
Yeah, I've been watching those bank sell-offs as well. It's pretty incredible how they've been moving around. Now, Rick, one thing that's interesting to me is even after this morning's data, you do see more than 4 rate cuts priced in through the end of the year. And then you have Treasury Secretary Scott Bessent saying that the short end of the yield curve is also suggesting that maybe the Fed funds should be lower too. Want to know what you think, because does really the economic data that we see right now warrant rate cuts so early in the year? You have one priced in right now to May.
So I've learned in my career, it's not a question of what I would do or how I would, what do I think they will do. And I think today this Fed will wait. And I think this Fed will take its time. Like you saw, you look at this payroll data, and you take inflation that's running, depending on the metric you use. So let's say you use core CPI. I know they prefer core PCE, but if you use core CPI and you're running at the 3-month, 6-month moving average of 3%-ish, and then but pre-tariff, so you add another 30 or 40 there. Listen, it's not really an environment for that this Fed would interpret that and say, time to cut. So listen, I think the labor data will, you know, we talked about around openings slowing. I think the labor data will open up the window as you get into the June meeting, or maybe a little later than that, to get a couple of cuts done. But I think interpreting that they're going to cut off of today's data, I think, is presumptuous.
I want to correct myself here. They're not pricing in May. They are pricing in one in July. And actually, you do already have a little bit of a change in the pricing already for the end of the year.
We're studying the warp function here.
It's changing on me this morning, Rick. Forgive me.
Even as a budding equity guy, I'm sure you still remember WIRP Go on the Bloomberg terminal. BlackRock's Rick Rieder, fantastic spending some time with you. Have a fantastic weekend, Rick, and can't wait to see you back here in New York City. Some more movers on our radar today. Duolingo jumping as AI fuels strong results. Katie's learning a new language with that software. Take-Two is falling after delaying Grand Theft Auto Isn't it 7? Grand Theft Auto 7 until next year?
I believe it's 6, according to our producer.
Yeah, sorry. VI. It is 6. So it won't come out until 2026. Gamers are bummed. Take-Two is down. By the way, Electronic Arts is soaring on that. And Reddit says revenue in the current quarter will be higher than Wall Street estimates, but apparently investors still don't like the stock. It's off 4%.
Well, funnily enough, Bloomberg spoke with Reddit's COO Jen Wong about the company's growth. Let's take a listen.
It was a strong quarter for Reddit. Users were up 31% year over year. Revenue was up 61% year over year. And we're seeing continuing momentum from Q4 into Q1 and Q1 into Q2. I think the work that we're doing is working. When I think about our roadmap, making Reddit more accessible to people globally, improving the product.
All right, it's time now for top calls from the analyst action in focus this morning, and we start with Airbnb getting downgraded at Wedbush on slowing U.S. travel trends. The company also reported a disappointing Q2. Next up, we have Block getting downgraded over at Wells Fargo after reporting earnings well below Wall Street expectations. The fintech company also cut its guidance, citing macroeconomic pressures. You can see shares down a whopping 23% right now. And finally, Apple getting hit with 2 downgrades today. That's after it reported earnings last night that reinforced concerns over tariffs, also its growth potential. Those 2 firms are Jefferies cutting the stock to a sell and Rosenblatt downgrading the stock to neutral. Shanali.
Sell is a tough place to be living in. We're going to stick with Apple because it was a busy week of tech earnings with Apple, Amazon, Meta, and Microsoft all reporting. Let's recap it with Jordan Klein. He's the head of technology specialist at Mizuho Americas. Apple. Right. I mean, when you look at the exposure it has to the broader economy, when you look at the sentiment from Wall Street turning on the company a little bit here, how do you see the path playing out for the remainder of the year, given the uncertainty around tariffs?
Yeah, thanks for having me. I think Apple's clearly going to be in that kind of wait and see bucket. I mean, Tim Cook and the management team got a lot of questions on the earnings call about tariff impact, how they would adjust their global manufacturing footprint to minimize costs. I think they did a pretty good job of laying out what they will do to avoid, tariffs and adjust the, where they make the phones coming into the United States to kind of alleviate some of the concern. That being said, the biggest overhang, in my opinion, is what do consumers do in terms of do they need and want to go out and buy a new expensive phone that's $1,100, $1,200 right now? The economic outlook looks relatively unclear, but right now the data is okay. So I think for the time being, it's going to be in that, I don't feel like there's more upside to earnings estimates. I think most people feel like right now, if you had to guess between now and 6 months, there would be more downside risk. So to me, it's just a matter of people wanting to put their money probably in safer names.
It's crushing to see a 19% drop year to date on Apple. I will point out, though, that there are still only 4 sells out of 60 people looking at this stock. So I don't think anyone's excited to get out, Jordan. What about the importance of Amazon, the importance of Microsoft? You noted to our producers that you think they're by far the most important of the 4 big 7 that have reported this week. Why?
Well, I kind of was saying this week that what was going to matter the most for tech sentiment and investor sentiment would be the big cloud hyperscalers. Not stocks like Apple that have a lot of consumer overhang, but Microsoft, Amazon, Meta, and they come after Google because these are the companies that are spending hundreds of billions, have these massive cloud footprints. They touch all areas of the economy and basically the enterprise. So what they were seeing in terms of AI and just regular cloud demand and how they were going to approach the need for more data center capacity to handle that demand was going to be critical in terms of where these stocks in the tech sector would head next. And by and large, I think people came out of this week, despite Amazon being a little bit weak today, I think by and large, Meta and Microsoft were a big positive shot in the arm.
Yeah, absolutely. And you've seen that trickle through in the indexes. I want to talk about Amazon a little bit more. Amazon's a really interesting stock to cover, I imagine, because it's the world's largest online retailer. But it feels like the actual shares move more on its cloud business, what it's doing in being a hyperscaler. And I wonder, how you weigh those two different sides of this business as you cover this company.
Yeah, I mean, for the record, I'm not a publishing analyst, so I don't officially cover it, but I do follow it closely, and you have to if you are a desk analyst or a sector specialist like myself. So that is the challenge with Amazon, is they have two distinct businesses that are very different, but also very big, and one's growing really fast. That is the cloud business, and it generates pretty much the majority of their operating income. And the other business is retail, which is massive. And I think, the opportunity there is huge as they expand into new categories and new offerings. So right now, I think a lot of investors still want to see upside and strength in AWS. That's kind of what carries the higher margin or value. Whereas the retail e-commerce business, people know they're going to fight for volume and share at the expense of profit. And I think that's just kind of a given, but it kind of makes it different from all these others. So that's why I feel like right now Meta and Microsoft are just cleaner stories with tariff and macro headwinds. Doesn't mean Amazon's not a great company. It just means it's got more risk associated, namely from that retail side.
Jordan, you really saw a tale of two cities this earnings season with the big tech giants. Are these kind of more business-focused sectors immune to some degree to recession? Because you did see cloud spending, for example, as you said, hold up. Meta reaffirming those CapEx plans. Does that hold, though? I mean, people are flocking to these to a relative strength relative to the consumer-focused names.
Yeah, I mean, that's always the debate that investors will have, is how I wouldn't say none of them are immune. When you see market weakness or any sort of risk of a recession, spending and growth will fall, obviously. But I think what's different this time is that companies are seeing cost savings and efficiency gains from moving their IT spend into the cloud. And they're definitely seeing benefits and are excited about doing more AI-enabled projects to drive either better customer support, customer relations, also take market share from their competitors. So that's what I think has held up the best, is the cloud and the AI spending. But general enterprise, you are seeing some companies take longer to close on deals or size them down. And I think the debate is going to be, where are you most insulated within these IT tech companies? Like, do you want to favor large mega global companies that have, a very diversified footprint? Or will the more nimble, smaller companies that focus on small to medium businesses be safer because the deal sizes are smaller? But right now, I think people are favoring probably the larger size companies.
Jordan, great to get some time with you. Hope we can catch up again soon. Jordan Klein there of Mizuho talking about the big tech earnings that we've had. Obviously, the M's were yesterday, the A's today.
They didn't do as well as the A's, but still, that's not stopping this market right now with the S&P 500 higher by about 0.9%, now 0.8%. Some of those early gains just lessening a little bit, but still, the S&P 500 now for the year only down 3.4%. Much more coverage of this market coming up next. This is Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on with stocks. They are up. Not as big as they were at the open, but the S&P is still gaining 0.9% on its 9th consecutive day of gains. If we keep this up, it'll be the longest winning streak in 21 years. The NASDAQ up 1%. We've had a lot of earnings that I guess really disappointed. Apple we've been talking about all morning, and Amazon as well. These two big stocks are down, so it's pretty surprising with those heavy moves that the indexes are still up. This story I know well. Grand Theft Auto coming out with number 6. I guess people were hoping this year. Now it's not until next year, so Take-Two is down. Electronic Arts, as a result, gets a boost. And then Airbnb and Block apparently disappointing with earnings as well, especially Block, down 22%. So a big drop there. A look at what's ahead today and next week, really. At the top of the next hour, we get factory and durable goods orders for March, so Mike McKee will be watching those closely. Tomorrow, Berkshire Hathaway holds its annual meeting in Omaha, and the Buffett indicator shows that stocks are still cheap, by the way. Jess Menton writing on the BN side. On Monday, we kick off our special coverage of the annual Milken Institute Global Conference, so you better believe Shinali's on a plane there this weekend. Treasury Secretary Scott Bessent will be on Capitol Hill Tuesday, as we told you about, and Wednesday as well. We'll show you both of those testimonies. On Wednesday, the Fed decision and Powell's news conference, and that means we also see Tom Keene back here on TV. The Fed decides. Coming up next, PIMCO's Tiffany Wilding joins us here on Open Interest, then David Kelly from JPMorgan. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shanali Bassick.
And I'm Katie Greifeld. We're looking at the 9th day of this rally on the S&P 500, higher by about 0.9% right now as we await even more economic data dropping in just a couple seconds. Big tech, too, chugging along, even though the A's disappointed last night with Apple and Amazon.
We are getting economic data. Factory orders are not as good as we had anticipated, but they're better than the last reading by a hell of a lot. If you look at durable goods orders, they're bang in line with the expectation and at 9.2%, exactly what they were last time they were reported.
We're going to now bring in Bloomberg's Michael McKee to parse through the economic data a little more, put it into context, given we've been seeing a lot going on this week, and of course, those strong job numbers this morning.
Well, the biggest news in this is always the non-durable manufacturing, because we get the durable goods orders earlier and non-durables up just a little bit, not the kind of news that's going to move the markets at all. And the big increase in durable goods orders overall is Boeing. It was up 139% in terms of orders. So that one we take out, and you kind of look beyond that. And you look at the capital goods orders, non-defense ex-air, up 0.1%, same as in the original report, and that is okay news. Businesses are spending, but remember we saw a big increase in business spending for the in the GDP report in the first quarter, so that may be cooling off a little bit. And that's the question: are we cooling off? That's the question that came up in the jobs report. Is this the last one before we get to the calm before the storm, as it were, which many cliche spouting economists have written this morning? The idea that we did get a decent number of jobs, 177,000, but that was down from the prior month, and we see some cooling in there. And is this going to really take off and go down as we watch the months go by and the tariffs take hold?
All right, Mike McKee, always appreciate the breakdown. That is Bloomberg's Mike McKee. And let's put it all together now with Tiffany Wilding. She is PIMCO's economist joining us now. Tiffany, it's great to see you. It has been a busy, busy week when it comes to economic data. We, of course, had that GDP contraction. Now we have a very, very strong jobs report for the month of April, and a lot of question marks about where we're headed in the months to come. How are you thinking about the balance of risks right now?
Yeah, well, I think what the data showed you over the last week was that the period of time ahead of the actual tariff implementation for the U.S. economy was just actually quite a solid period of time. And part of the reason why it was so solid was because people were expecting tariffs and they were trying to hurry up activity ahead of that. We clearly saw evidence of that in the GDP report with the trade data. We've seen evidence of it in the consumption data, with sequentially consumption actually getting quite a big boost in March for people hurrying up to buy cars, for example. And we actually think that some of that is showing up in the labor market data. So if you look at the strength more recently, you kind of smooth through the noise. Any given report can be noisy. What you find is that the trade sectors, so wholesale, retail trade, logistics, warehousing, even manufacturing, that's actually accelerated in terms of monthly average net payroll gains since the election. And we actually saw a similar acceleration like this in Trump's first administration ahead of tariffs then. So I actually think some of the resilience within the labor market is also the reflection of just this hurry up in activity, which has caused more jobs to be created there as well. But all that, is kind of looking more vulnerable as we look forward because we know, these higher prices that will have to be charged as a result of tariffs will hit volumes and that will hit activity.
Tiffany, everybody this morning, before the number came out, like Ajay Rajadaksha and Sarah Wolf and Mohammed El-Arian on surveillance were saying, don't ignore the supply shock of mass deportations, of the closed border. We could see, a lower jobs number and lower unemployment. We could see upward pressure on wages. It looks like we didn't get that in this print, but are you watching out for that in the labor market in general?
Yeah, exactly. Yeah, I don't think anybody expected the tariff-related disruptions to show up in this labor market report, but there absolutely is some potential for payroll growth to slow as a result of the lack of immigration that we've seen, and what we think is the lack of issuance of work permits, even rolling over work permits that have expired. So that we think could be a labor market disruptor at some point. Certainly could slow payroll growth. It's difficult to pinpoint exactly when that will show up. And it's also difficult to pinpoint and understand exactly how the labor market reports will reflect that in real time. When we look at the household survey, they do give us statistics around, foreign or domestically born folks and how they're entering the labor market. Those statistics actually have not shown any drop off in foreign-born labor force participation gains, and things like that. So we're not seeing that yet, but we think at some point that will probably come through as well.
Tiffany, we've been looking every morning at the WIRP function on the Bloomberg terminal, taking a look at what traders are pricing in for rate cuts. And a little earlier this week, it was firmly 4 cuts. You look this morning after the jobs data, 3.5. So those expectations are coming down. Now, when you look at the strong jobs report we got this morning, does it give the Fed more ability to focus on the inflation part of their mandate? Does it make the idea of a softening economy be something they look at further down the road because the labor market hasn't bended yet?
Yeah, so I think that the issue and the constraints on the Fed, still remain squarely on the inflation side of the mandate. We have not seen a deterioration in the labor market yet. That's the bottom line. But inflation expectations have really started to accelerate higher. And central banks are targeting inflation expectations just as much as they are targeting realized inflation. So I do think that's a concern for them. We've always said that they probably need to see data in hand. They have to have data in hand, that really suggests the labor markets are decelerating quite quickly or even contracting. And again, I think the risk here, as we've been saying, is you don't actually get that until the middle of the summer or maybe even late summer. So you don't have that data in hand until the fall. Mm-hmm. So I think the bottom line here is that we haven't actually seen the inflation hit the consumer price data. We think that changes in May as a result of the de minimis exemption, where you could have packages come in the United States free of tariffs if they are under $800. That exemption expired overnight. So once consumers actually see these higher prices, and once we start to see the volume declines from that, then we'll get a better sense of how this is going to impact the economy. But we might not really start to see that, until actually May or even June, which means the labor market reaction to that is going to be even later.
Right. Well, let's talk a little bit more about prices and the consumer. There was a really interesting moment on the Amazon call last night when we heard from CEO Andy Jassy. Here's what he had to say. We haven't seen any attenuation of demand yet. To some extent, we've seen some heightened buying in certain categories that may indicate stocking up in advance of any potential tariff impact. It's interesting, Tiffany. I feel like you've seen this across industries, across products, this pull forward of demand. And in your view, how does that trickle through into prices in the months to come?
Well, I think the interesting thing is even though we've seen that stronger demand, some reacceleration there ahead of this, we haven't had, or there's less evidence of vendors that are charging more as a result of that higher demand. So it does look like you're seeing inventory stocking ahead of all these tariffs at the pre-tariff hike prices or costs. That's still the inventory that's being sold right now. And again, vendors and wholesalers, retailers, et cetera, they haven't started to raise prices. But eventually that inventory will be gone. Consumers will have bought it all. Businesses will have bought it all. And there will have to be tariff hikes. And again, I think it's just a question of the lags here and when you start to see those increases. And that's going to give you a better sense for how consumers are reacting to all of this.
Tiffany, thanks so much for joining us. Really appreciate your input on a day like today. Tiffany Wilding there of PIMCO talking us through this big data on this big day for markets. Let's get a look at the stocks moving as we gain for a 9th consecutive session. We bring in Bloomberg's Emily Graffeo with that. Emily?
Okay, Matt, so the indexes are up, but the individual movers are moving lower. At least when you look at Airbnb, shares are falling 2% after the travel company gave a week outlook for the second quarter. They blamed economic uncertainties for the softer travel demand in the U.S. And of course, this report underscores that weakening consumer sentiment, even though when you look back, the first quarter results were pretty good for Airbnb. They beat on revenue, gross booking value, and adjusted EBITDA. But really the focus here is all what happens next as the tariffs work their way through the economy. I'm also watching shares of Reddit here. The stock was up higher, pairing gains a little bit, but still in the green. Their second quarter revenue and EBITDA forecast topped estimates. Bloomberg Intelligence flagged that they have a low exposure to Chinese advertisers, and they also have stable user and engagement growth. So even amid trade war and tariffs, people are still essentially going to be using Reddit. The first quarter results were also solid. Revenue here of $392.4 million was up 61% year over year, and it also beat estimates. Finally, Block, it's a different story this morning. That stock plunging the biggest intraday drop here since March 2020. It was down as much as 24%. The digital payments company cut its gross profit guidance for the full year. And they said that Cash App card spending was really the weak spot here for Block. The CFO said the largest hit came from those discretionary categories. So people pulling back spending in media and travel, which actually jives well with what we saw with the Airbnb reports. The spending in categories that were stronger, essentials, gas, groceries. It's not exactly what you want to hear if you're expecting an economic expansion here.
Emily, we thank you so much for looking under the hood for us. Now, coming up, David Kelly, Chief Global Strategist at JPMorgan Asset Management, why he says the prognosis on the American economy is gloomy, but not disastrous. That's up next. This is Bloomberg Open Interest.
Let's get a look now at high interest, what's making headlines around the world. The trade war may be softening between China and the U.S. Beijing said it was considering the possibility of trade talks. It's the first sign that negotiations could begin between the two sides. China's potential pivot comes as tariffs appear to have taken a toll on Chinese producers. An official report on manufacturing activity showed that factories in China saw their sharpest monthly slowdown in over a year. Obviously, the U.S. is eager to start those talks. President Trump says Harvard University will lose its tax-exempt status. The designation has allowed the school to avoid paying taxes on its income. Trump posted the announcement after weeks of threatening an IRS review of the Ivy League's tax-free treatment. Conservatives have targeted Harvard and other elite universities over allegations of a rise in anti-Semitism. Trump and other Republicans have also accused the institutions of promoting liberal agendas. And Take-Two software is falling after it announced it will delay the release of Grand Theft Auto 6, which was supposed to be released at the end of this year. The game is now expected to debut in May of 2026. It will miss the holiday season. It's already missed multiple deadlines, though. Rockstar Games, the studio behind the blockbuster, says the team needs extra time to finish what's expected to be one of the most lucrative video games of all time. And I haven't played any of the most recent versions, but I have wasted probably months of my life on Grand Theft Auto in its earlier iterations. I'm wondering if the two of you ever play?
I have. It's been a while. But I will say this, Katie, you have video games and they're like movies where there are certain ones that are just big hits. And it makes up for a lot of the money that these firms make in a given day. They have Strauss Zelnick, the CEO of Take-Two, fully supporting Rockstar Games. They want to realize the creative vision, but it is supposed to be one of the most lucrative video games ever, and missing those holiday sales is a big deal.
Yeah, I'm more of a Stardew Valley gal. I can't say I've ever played Grand Theft Auto. It's interesting that you're seeing such a dramatic reaction in the shares, given that you have the sell side saying this is disappointing, not disastrous, and it's not that big of a surprise, but again, wouldn't know it by looking at Take-Two shares today. Let's take a look at the broader market, though, because we have the S&P 500 extending its gains a 9th straight day. I wonder how many times we'll say that. You can see it up 1.2% right now. The 2-year Treasury yield, we also threw it up there, given that we had that strong beat on payrolls this morning. The 2-year yield rising by about 7 basis points as traders really pull back some of their Fed rate cut pricing. And then we have crude there as well. Crude below $60 a barrel. This move had already started, but then we had the breaking news that OPEC Plus is bringing forward its call to discuss the June output to Saturday, according to delegates. So just putting some more nervousness in the crude market, Shanali.
We're going to now go to the Wall Street Beat. Joining us now for a view on the economy is JPMorgan's David Kelly, who's chief global strategist over at the firm. You know, you take a look at the data we've had all week. The jobs report seemed to provide a lot of reprieve. You are seeing the stock market really reacting in a very positive way on the heels of that. But we didn't have good data all week, and clearly Wall Street is still a little nervous about what's ahead. How do you start to paint a picture on how to think about the rest of the year?
Well, I think Wall Street should be nervous. I mean, we're not seeing that in markets today, but what we have here is a tale of two lags. So there's a lag between GDP growth and employment. Companies don't want to fire people or lay people off until after they see a decline in output. And there's also a lag in the data itself. I mean, these numbers reflect the survey week, which is the week that ended on the 12th of April, 1 week after the April 2nd tariff increases. The next report, the May jobs report, which we're going to get in early June, that's going to reflect a 5-week period. And I think you're going to see some deterioration in jobs in that period. So I think there is some softening coming here. But overall, it's, you know, the economy is slowly weakening here. And I think it's going to get hurt by tariffs. But there's just a lot of distortion in the data this week. So, you know, I think that's confusing people. But I wouldn't take too much comfort in these numbers.
I mean, would you take comfort in a 9-day winning streak, David? It's pretty insane to see this kind of move. We haven't had that long of a string of gains since 2004. You know, a lot of people trading in this market were, you know, in elementary school then. So what do you think is driving these incredible gains?
Well, I think we've been taught for many, many years that you buy the dip, and when the uncertainty begins to diminish, you just pile on in. And I do think the tariff uncertainty is going to drift away here. You know, obviously there's not a lot of clarity about how we're going to end up with China, but I think what's happened since April 2nd is the administration has realized that these overall reciprocal tariffs really aren't likely to stick, and it's not something that they can really stick with over time. So I think they'll try and get back to a 10% universal tariff. I think they're going to try to negotiate China down. But of course, I think China's calling our bluff here. So I think that'll be easier said than done. But if we end up, you know, in a few months' time with much more clarity on tariffs, that's a positive for equities. And the other thing we haven't talked about that I think is very important here is the House Ways and Means Committee is working on a big tax bill. And I believe that despite all the talk about cutting government spending and cutting deficits, there's going to be a whole pile of fiscal stimulus sugar in that bill.
Right.
And I think that's really what the Federal Reserve is worried about and waiting to see before they commit themselves to rate cuts.
I can understand why the Fed would be worried about that, but let's talk about what it would mean for the market a little bit more, because something we've been talking about on this show over the past couple months is the sequencing of it all. The fact that the Trump administration led with, of course, trade policy. That is the priority, and that hasn't been very palatable to the markets. Some of those tax policies that we're talking about, obviously that would be taken a little bit more friendly. So if this works out, that we do get this easing of trade tensions, this fading away that you describe, and we also get the sugar rush of potential tax cuts being extended, how does that set us up in the second half of this year, David?
Well, I think there are two things. One is the timing on these tax cuts are really important. I mean, obviously extending the Tax Cut and Jobs Act of 2017 just kicks in January 1, doesn't change anything. But the president has talked about a cut in the corporate income tax rate from 21% to 15%. Is that a January 1, 2026 issue? Or could that be a July 1, 2025 issue? And similarly, other tax cuts, income tax cuts. I mean, if the Congress and the president want to use tax cuts as fiscal stimulus, you could kick them in the second half of this year. And that would have a major impact in bouncing the economy out of whatever weakness is going to emerge because of these tariffs. So I think we have to take a look at that. But overall, I think the stock market would react well, particularly if we lead with corporate income tax cuts and go a little lighter on the stimulating consumers. But for the bond market, I do think this means higher rates if we get that tax package. So we're going to be watching this very closely.
David,
and meanwhile, the Fed is going to stay on hold.
David, you know, it's interesting. Usually people like a lot of sugar with their meals when you think about that fiscal stimulus that you might see from the tax package. At the same time, you have seen, to your point on higher rates, the long end really start to slowly take off once again. We were at 429. We were at 420 earlier in the week. We had 7 days of declines being snapped in the last day and a half. Do you think that come summertime, we're going to be sitting here worried again about the fiscal situation of the United States, especially now in the middle of these trade tensions? There's a lot less trust among our partners across the world.
Well, that's right. And I mean, I think the asset test is there any seriousness about cutting government spending and actually cutting the deficit? Because a lot of the Doge cuts, I mean, you saw in the federal employment numbers that came out this morning as part of this report, we haven't really seen a significant drop in federal employment at all. Not according to the Bureau of Labor Statistics. So maybe it should be coming. And if that happens, that's something to look at. But even then, you're looking at bigger deficits going forward. And, you know, the fiscal sugar is all very well and good, but what we need is fiscal protein. I mean, we need something that actually builds the growth rate of the economy in the long run. Corporate tax cuts probably do that. Cuts to taxes on Social Security, overtime, and or Doge dividends don't do that. And so I think the bond market will be looking at that. I think the Federal Reserve will be looking at that. And also, as some of your earlier guests talked about, you know, these immigration restrictions. If net immigration heads towards close to zero in the U.S., that will further limit our long-term growth potential.
Yeah, fascinating stuff. David, great to have you on the program. Thanks for joining us. David Kelly there of JPMorgan Asset Management. This is Bloomberg.
All right, coming up on Open Interest, Duolingo raising its sales and profit outlooks for the rest of 2025. Certainly rare to see in this earnings season. We'll talk about it with the company's co-founder and CEO, Luis von Ahn, next. This is Open Interest. Well, AI is powering Duolingo's present and its future. The stock absolutely flying after the language learning company boosted its full-year sales and profit outlook last night. Duolingo seeing significant growth in its AI-powered features, including video calling and new courses. Joining us now, I'm pleased to say, is Luis von Ahn. He is Duolingo's co-founder and CEO. Great to have you with us. Let's talk about AI. Obviously, you've pushed aggressively forward with AI, and you have big spending plans as well. And I'd love to get a little bit more detail on where those investments are actually going. Are you spending on talent? Are you spending on infrastructure, content? Where's the money going?
Yeah, well, thank you for having me. Yeah, I mean, AI is really positive for our business. We are, there's a number of places where it can help. One of them isn't just creating new features that were not possible before. A good example is the video call feature where you can practice conversation with one of our characters, Lily. We're spending quite a bit on R&D on that, and we're going to continue hiring people to help us develop that. We're also working on just content generation. So generating all of the content can be done a lot faster now with AI. And what that allows us to do is just have way more courses. Each of the courses has way more content, and that allows us to serve more users. And then the last thing that we're also doing is we're also, all of our workflows, we're trying to make our own employees a lot more efficient. And this is not about reducing our workforce or anything like that. That's not what we're doing. We're keeping all of our employees, but we want to be a lot more efficient and for each of them to work on creative tasks rather than repetitive tasks.
Let's talk about that a little bit more, that you're not necessarily reducing the workforce here. You came out with the news earlier this week that you're launching 148 new courses with the help of AI. I spent a lot of time on TikTok. I know that the Duolingo team does as well. And there was a lot of pushback to this AI first push. And I wonder, what your response is to some of the concerns that have been raised about how this impacts the humans.
Yeah, I mean, there's some real concerns about, of course, people and employees. I mean, we're a company that really cares about our employees. I think there was some misunderstanding. There's basically, I sent an internal email, and there was some misunderstanding. What we said is that whenever there is some job that can be done by AI, and it can be done really well, then we're unlikely to hire contractors to do that job. Already at the moment, most of the things that AI can do, we're not hiring contractors to do. So this is not a huge change. And for our full-time employees, there's no change whatsoever. We're going to continue employing them because this is such a big opportunity that we're going to be investing quite a bit.
I wonder about, because of the recent Apple news, the ruling on third-party purchases. How do your customers typically pay you? I mean, do they do it in the app? Do they do it on the web? And does it make a difference to you?
Yeah. At the moment, overwhelmingly, our customers pay us from the app using the, Apple's payment system or Google's payment system, depending on whether it's Android or iPhone. The new ruling would allow us to test. I mean, we don't know what's going to end up happening, but we're going to test this. It would allow us to test having our customers pay us from a web view in the app. So it'll still kind of feel like you're paying us from the app, but it'll be a web view and it won't be Apple's payment system. That would save us quite a bit on margins. I mean, at the moment, Apple, for the first year of subscription, charges 30%. They keep 30%. That wouldn't be the case if we were to do this on a web view.
So it's interesting. Katie had mentioned TikTok a little earlier. I really admire how socially extroverted she is because
it's a vice.
Yes. When I go home, I learn how to play strategy games, chess in particular, something that you have recently launched on your platform for lessons. I'm very curious about why you had done this and what it means for other potential games on Duolingo.
Yeah, we're not viewing chess so much as a game. I understand that it is a game, but we're viewing it more as something that's educational. It turns out that learning chess really helps for all kinds of things. I mean, it allows people to think more logically. And so we're viewing it as another thing that we are teaching. We chose chess as our next subject because there really are hundreds of millions of people that are either playing chess or interested in playing chess. I mean, if you just ask around the people it's like, would you want to learn chess? Most people that don't know chess tell you something like, oh, I've always wanted to learn this. So that's why we did this. It's not quite yet out in the app, but it's going to be literally in the next few days, at least in the iPhone app, where you'll be able to learn chess as a beginner, and it gets you all the way to kind of an intermediate level, and so we're super excited about it.
I can't not comment on this because I know that Shonali is here at 6 a.m. and stays working until like 8 or 9 p.m. So then you go home and you learn chess?
Correct.
Is that really what you do?
Chess and also lately poker. And that's why I was asking about games, because frankly, the strategy behind them is a huge social potential market.
I watch Netflix and eat Haagen-Dazs. Like,
Yeah, I go for a run and sort of unplug. But Luis, I know that you're not thinking about chess as a game, but I want to ask about potential future games. Obviously, you're moving forward with chess. What other sort of games, if you want to call them that, do you have potentially planned or are thinking about?
We're unlikely to do games. I mean, we're an education app. Ultimately, what we want to do is teach people things that take a long time to learn and that will improve their lives. So other subjects that we add will unlikely be games. By the way, at the moment, we don't have any serious plan to add other subjects after chess. We will eventually, but at the moment, we're more concentrated on the ones that we have already added, which is obviously language learning, but also math and music, and now chess.
I want to know about how well people actually learn languages with Duolingo. I mean, I took Spanish for years. I took French for years. I don't speak a lick of either one. German, I moved to Berlin, and within a month, I was speaking it because I was there. How well can you really learn a language using an app on a phone?
What really matters is the amount of time that you spend actually interacting with that language. And if you do spend the required amount of time, you can learn a language, and certainly you can learn language well in Duolingo. I mean, I've learned languages on Duolingo, and not only that, we have a lot of scientific studies that show that if you use Duolingo for the required amount of hours, you will get better at the language. Now, what ends up happening is that I think there's a lot of misconceptions about how long it takes to learn a language. To learn Spanish relatively well, you need to spend 500 hours. And this is not just on Duolingo. This is just how long it takes for your brain to learn Spanish. To learn Chinese, you need to spend about 2,000 hours. So yes, it works, and it works actually quite well with Duolingo, but you have to spend the time. Now, what we do really well with Duolingo is keeping you motivated so that you can continue spending the time.
Matt, just try Duolingo. I feel like we have this
You're right. You are 100% correct. I need to just take the plunge. No, you're right. You're right. I will do it.
And I need to keep it up. I am learning Spanish on Duolingo, but I keep on letting it up, so this is good motivation. Luis Von Ahn of Duolingo, we thank you so much for your time. Now, in other earnings news, we're watching Chevron because they are reducing share buybacks this quarter after President Trump's trade war and OPEC's plan to increase supply has hit oil prices. And Bloomberg's Alix spoke with Chevron CEO Mike Wirth a little earlier. Take a listen.
We had a very strong quarter. Our earnings were up 6% versus the prior quarter. Oil prices were relatively flat. Strong shareholder distributions, $7 billion in the quarter, and over the last 12 months, about $15 a share, and we're on track for industry-leading free cash flow growth by 2026, even at lower prices. And a big part of that is the Gulf of America.
Alix joins us now, and a really interesting moment in oil markets. Does everyone remember the drill, baby, drill kind of rhetoric that was going on in markets? You sat here last time you had spoken to Mike Wirth saying, it's not the moment for that. What is it the moment for, really?
Preserve cash, preserve cash, preserve cash. I mean, that's in essence what we've seen Chevron do, kind of preserve where you can. It reported earlier in the last couple of months that it was going to lay off 20% of its workforce just to right-size its business so it can manage these lower times. Now, for an Exxon and Chevron, that's all well and good. It's the smaller guys, like an EOG Resources, for example, that are going to feel the pain and maybe have to lay down rigs when you're in like a 50, 60 barrel environment.
Well, talk to us a little bit more about, those buybacks, because you have Chevron planning to reduce them, Exxon, it looks like Shell as well, still sticking to their plans. I mean, how is that being received among the investors and the analysts in this market that you speak to?
So luckily for Chevron, the reduction in shareholder payouts was widely expected because we've seen it from other big oil companies, particularly those over in Europe. The bad news, though, is that if you're an investor, how many oil companies do you want to own? And do you want to own the one that's actually not cutting your shareholder payouts? Right. And so that's where it gets a little dicey. Now, of course, you have to look at the overall stock price for Chevron. It's underperformed Exxon. So you could make an argument that you can be bullish on Chevron because of a valuation perspective, whereas Exxon's already maybe more fully valued, and some analysts are saying that. On the flip side, you got to get the Hess thing done. They have to have a yes or no when it comes to buying Hess. The arbitration is set for May 26th. You have to wonder what kind of overhang that would finally do for the stock if they wind up getting it. It would be accretive pretty quickly for their production and cash flow.
How long? I look at the oil price, Alix, at $50 or with a 50 handle, and I think this has to start coming through to the pump, right? I mean,
it is, right?
Well, Donald Trump says he sees under $2 in Florida. I'm seeing over $4 in Westchester. And if you look at the national average, We're at, I think, 318 for
Yes.
regular, and a lot of cars require you to put in more than regular.
Yeah, I was going to say, are you talking diesel? Like you're not talking regular.
No, but
unleaded,
I have to
are you?
put 91 octane at least in my car, and most people on this set probably do, even if Katie doesn't.
I still got mine for like 310 this morning.
I have a Subaru. Okay, so I'm like filling up for like 3 and change. But you're asking about
how long it takes to come through to the pump.
Yes. Okay. So twofold answer. One is that prices are going to be slower on the downside than upside because the actual retailer that's selling it to you doesn't want to lower it as quickly, or they can't. Right. The other part is refiner margins. Right. They were really not great for a while. They're expanding a little bit. Lower oil prices are good for refining margins, but you're still going to have a good enough margin to produce the actual product. So it's not a 1-for-1. Right. If I'm a refiner and I want to make cash and I want to make some money, I got to wait until the demand's really there. So maybe in the summer driving season, maybe if you have enough supply coming through, it may kick up, but then you got the demand side. So it's a 50-50. But hey, $4 is going to be better than like $8.
Yeah,
That's true. It is better than $8. This country has cheap gas prices.
Buy gas. I'm going to start to Google
But I
map
can't
that
drive
for
to
you.
New Jersey to fill up. That would be counterproductive,
I'm
right?
in New York State. Anyways, I want to pull up for you a point that you were making a little earlier, which is that investors are not really buying many companies right now. There's only 4 stocks in the energy index right now that are green on the year, and some of these firms are down 25% or more. Take a look at Halliburton, APA, Occidental, almost 20% lower. How much worse does it get, frankly? Because this is a fair bit of pain for this industry.
So I actually love that you pulled this up because Texas Pacific is a royalty company. So that's kind of like a different, it's like a leasing land company.
Land
so it's
corp.
different, yeah. The others are actually pipelines, so they are actually should, in theory, be benefiting from lower permitting time. And if you need to move hydrocarbons around the United States, no matter where you move them to, those guys are going to benefit because, in theory, I'm paying them to rent space on their pipeline, no matter whether or not I use it. But the more pure play oil guys, and that's where you're mentioning Oxy, and Oxy has other things to discuss as well. That hurts. I mean, it really hurts. Like, this oil price is rough. The forward curve has also come down quite a bit. If you're making a decision for oil prices 2 years out, it's better than it is now, but it still ain't great. And so how do you sort of resize your positioning and your CapEx from that?
All right, Alix Steele with all the nuances, great coverage, great reporting, and great interview. Of course, you can check her out on the close later today. But a quick check on these markets. You have still that 9-day rally intact. The S&P 500 up by more than 1%. Big tech leading the gains as you see that sell-off underway in the bond market. Now coming up, it's Vanguard's birthday. We'll talk about it next in Wall Street Week. This is Open Interest. It's time now for our Wall Street Week conversation. And 50 years ago, Jack Bogle launched Vanguard, which has seen 6 recessions in the U.S. thus far. I recently visited Vanguard's campus and sat down with current CEO Salim Ramji to discuss how the company is changing while still staying true to its roots. Bogle was the legendary founder of Vanguard, who went against what was then the investing grain.
How to decide on the funds is a little bit difficult. I'd say taking the most important part, perhaps the equity fund selection. I think a beginning investor in particular should go for sort of middle-of-the-road funds like fairly conservative growth and income funds or growth funds, and even, as suggested by your remarks at the outset, maybe a little seasoning of index funds wouldn't be so bad.
Described you as an industry statesman.
When Bogle appeared on Wall Street Week with Louis Rukeyser in the early 90s, Vanguard had around $100 billion in assets under management. Today, it's grown to more than $10 trillion. And through the growth, Bogle's philosophy remains. Well, you have a really interesting job because, you have to thread staying true to the roots that Jack Bogle laid down 50 years ago, but also positioning Vanguard for the future and, future-proofing Vanguard.
Yeah, I think first is understanding our history and understanding our culture. And I've also benefited that first, Bogle wrote a lot. And so not just in his books, but in all the historical archives and speeches and in the memos and the like.
He was a quote machine. One of Bogle's famous sayings tells the story of passive investing. Don't look for the needle in the haystack, just buy the haystack. It's a philosophy so popular, it generated an online following of passive investors known as Bogleheads.
One of the interesting things is Vanguard's always changed. Like, we've maintained our sense of consistency around our purpose. Whether you can think about our moves into advice, our moves into ETFs, our moves into if you go back into the 90s or moves into retirement, these were all changes in the business model. But so I sort of look at what I'm here to do is to continue that tradition and that kind of duality between staying true to the purpose and also changing things as we need to change and adapt based on our client needs.
Buying that haystack today looks a little different than it did during Bogle's days. But Vanguard makes no apology for sticking to its tried and true approach to indexing that avoids the trends of the day.
You could start to have to really think about how do you stay true to the roots while also, giving clients what they want, because those clients, specifically in advice and wealth management, I could imagine them requesting private assets, which I know that Vanguard is pursuing, but I could also see them asking for Bitcoin and crypto, which famously Vanguard isn't too hot on. So I wonder how you're thinking about those sort of potential run-ins.
We're not going to be everything to everybody, and that's okay with us. That's been true for kind of the history of the firm.
And that was Vanguard CEO Salim Ramji. You can catch Wall Street Week tonight and every Friday at 6 p.m. Eastern. Now coming up, Vanguard's S&P 500 ETF, speaking of Vanguard, just notched another record. We'll bring you that next in our ETF Friday. This is Open Interest. It's time now for ETF Friday, and the world's biggest ETF just got bigger. Vanguard's S&P 500 ETF took in nearly $21 billion in inflows last month. That is the most in its 15-year history. Let's dissect that now with James Seyffart. He is Bloomberg Intelligence ETF analyst. James, it's just amazing how much VU has taken in, not just in April, but this year and last year, breaking record after record. But it's coming up against some pretty strong seasonals. Sell in May is a mantra for a reason. Would you expect to see any let up when it comes to these inflows?
Maybe a let up, but they're not going to turn into outflows. I mean, this thing is an inflow machine. It's now the largest ETF in the world. It's a testament to retail investors, really. But when we look at these ETFs, there's no way to know exactly who's the one buying these things, but you can kind of look at the way that they trade and flows occur. And VU is one of those products that's heavily used by retail traders. It's just like every 2 weeks, people with their paychecks, they end up going into things like VU, and VU is the leader in that regard. So that's why we saw a record month in April. We've seen over $50 billion come into that fund this year. And when you think about the volatility that we saw in the market so far this year, and still we had those record inflows, people buying the dips, it's honestly impressive.
When you look at inflows and outflows in ETFs in general, across the whole universe, are they much more active when retail traders are exuberant about the market?
So when the market is doing well, you tend to see this underlying drumbeat of a trend of money just keeps pouring in. So in years when the market does really well, is up big, like 2024, you tend to see record flows, which is what we saw in 2024. But also when you see market volatility like we saw in the last couple of weeks, couple months even, there's a lot of dip buying, but money is actually moving to different products. We saw a lot of buying of low volatility stocks. Bond funds actually took in a decent amount of flows. People were making really big bets on leverage ETF products. So we saw huge bets on levered long and levered short ETFs. So the activity just really picks up and ramps up in sorts of volatility. But over the long term, a stronger market typically means it's better for flows in a given year. But that wasn't necessarily the case over the last month. We saw tremendous inflows, and it was still to U.S. stocks.
Matt, I appreciate that you went broad, but Chanel, I actually want to narrow back in again on VU because this thing is a monster. It hasn't posted a monthly outflow since November 2022. It has never posted an annual outflow. It's amazing.
It's the closest thing to a sure thing, at least since then. James, what's not a sure thing? We've seen a lot of popular products come into the market, but this market is different than the ones we've seen in recent years. What's become unpopular?
What's become unpopular? I mean, really, we've seen a trend of money moving away from. So honestly, what's become unpopular is for global ETFs, U.S. focused investing is always dominant, right? So Europe, it tends to be over 60%. It's a little bit less that they're going towards the U.S. Everyone's people are moving away from the U.S. But ironically, so far this year, U.S. investors were piling into U.S. equity. But European investors, actually, the last 2 months we've seen outflows from U.S.-focused ETFs. So the U.S. investors don't care about these tariffs. They're still investing with a home country bias. But when you look elsewhere in the world, Europe, APAC, those types of places, any ETFs that are investing in the U.S. have actually seen outflows the last 2 months, which is something we haven't seen in a very, very long time on an aggregate basis. So really, U.S.-based exposure, if you're an investor outside the U.S., is what's been unpopular.
All right, James, great to catch up with you. Have a great weekend when you get there. That is James Seyffart of Bloomberg Intelligence. You can read all about the ETF industry if you subscribe to my newsletter, ETF IQ. The link there is bloomberg.com/ETF IQ. Ideally, you would subscribe and open the emails, but I can't ask for everything.
But you have a TV show also about ETFs.
Well, we usually do have a TV show on Mondays at noon. Not next Monday, though, because as Shonali knows well, it is Milken next week.
It is Milken, and we start you Monday morning with Jane Fraser, the CEO of Citigroup, CEO of Apollo, Mark Rowan, PJT Partners CEO Paul Taubman, Capital Group's Mike Gitlin. We got a lot on the plate.
Yeah, a lot coming up. Very much looking forward to Shonali at Milken. We're going to bring you all of those interviews. This is Bloomberg Open Interest. Have a fantastic weekend.